Hi, my name is Christian Waldegrave, market analyst at Teekay, and I'm here to talk about the conventional tanker market. And since it's our first update of the year, I thought it'd be a good chance to review what happened in 2011 and then look ahead to 2012 as well. 2011 no doubt was a disappointing year in the tanker market. Fleet utilization probably fell by 2 or 3 percentage points, which then translated into low tanker rates. And that was really a combination of relatively high tanker fleet growth. Tanker fleet grew by about 6% last year, and relatively weak tanker demand growth. Tanker demand only grew by about 2 or 3%. And really there were lots of factors last year that made tanker demand side so weak. We had some things like the European debt crisis in the second half of the year, which was a drag on global oil demand. We had some one-off factors and events such as the earthquake in Japan in March and the war in Libya in February and March as well. And those things all translated into lower oil demand. And also one of the things we saw last year was shorter voyage distances, and that was really a result of the price of oil in the Atlantic being much higher than elsewhere, and so we saw refiners in Asia taking more crude from the Middle East versus the Atlantic. So we almost had this kind of perfect storm of factors of shorter voyage distances, lower oil demand, high fleet growth, which meant that rates were the lowest since the 1990s. Looking ahead to 2012, we still think it's going to be another challenging year, especially for crude tankers. We think the rate of tanker fleet growth will slow. So last year it was 6%, this year we think it will come more like 4 to 5%. But that fleet growth will be skewed in the bigger crude sectors. So VLCCs and Suezmaxes, we still expect fleet growth of 7 or 8%. So probably those larger crude sectors will take longer to recover compared to, say, Aframaxes, where we only expect 1 or 2% fleet growth this year, and the product tankers. Looking on the demand side, we're still seeing that global oil demand is being affected by what's going on in the economy, especially what's going on in Europe, but also we've seen a bit of a slowdown in China as well. But we think that through the course of the year that will improve. We're not expecting a full-blown recession like we had in 2008, 2009. We think that it's just a temporary phenomena, and as we move further into 2012, global oil demand will recover. And that will get around 1 million barrels a day of oil demand growth. And we also think that voyage distances will lengthen once again in 2012. What we've seen is that that spread between, say, Brent crude and Dubai crude has narrowed, and that means that Atlantic crude is becoming more attractive once again for Asian refiners. So we think that voyage distances will lengthen, and overall we expect that we'll get tanker demand growth of somewhere in the range of 4 to 5% this year, which balances the fleet growth of 4 to 5%. So overall we expect it'll be a fairly balanced year, which means similar rates to 2011, but getting better in the second half compared to the first half. So we think the weaker part of the year will be in the first half of 2012, and we'll get more into balance in the second half. And then sector-wise, as I've touched on, probably the large crude sectors will take longer to recover. Maybe the VLCCs and the Suezmax won't see a recovery until nearer 2013, whereas on the Afras and certainly the product tankers, we expect better rates as we move into the first half of 2012. Of course, the one thing we can't predict are any kind of wild cards. Last year we had the Japanese earthquake, we had what was going on in the Middle East and the war in Libya. Something like that could well happen in 2012, and the one thing that everyone's keeping an eye on at the moment is the situation in Iran. The US has implemented stricter sanctions on Iran, and now the EU has said that they'll probably ban oil imports. So that's going to have some impact on trade patterns, and we've also seen some saber rattling in the Straits of Hormuz. Iran threatening at some point that they might close that Strait of Hormuz, which would have a big effect on the tanker market, of course, because upwards of 50 million barrels a day travel through that strait every day, so it's a very important passageway for oil transit. So we'll keep an eye on developments there. At the moment we don't see it having a big effect on the tanker market, other than it's giving a bit of support to oil prices, which is leading to higher bunkers, which of course is a negative for tankers. But other than that, we don't see a lot of immediate impact, but it's certainly something to keep an eye on for 2012. So that's our update for January and our view for 2012 in the coming year, and we'll give you another update in February.